What's up, property people? Today in this video I'm going to share the 7 worst real estate types that you need to be avoiding in 2026. I put this through a simple 5-part framework that I'm going to share with you in just a second, but if you don't know who I am, my name is Andrew Bean. I own and control over $18 million of residential and commercial real estate. And I'm making these videos because I want to share the decade of knowledge that I built up in this space. Alright, so this is the simple 5-part framework that I use in all my own personal deals to figure out whether or not it's the right investment for me, and most importantly, if it's the right time to invest in that type of asset. I use this exact framework on every single opportunity I look at, and it works really well for residential, commercial, or specialty assets. The way that it works is simple. I run every opportunity through 5 lenses, and if it stacks up on all 5, then I lean in and look further into investing in that type of asset. Or if it doesn't, I just walk away and move on to the next deal. And these lenses purely just help me cut through the noise of the hype and emotion of investing in real estate and help me purely focus on the risks, returns, and overall portfolio fit. So this is how it works. The first lens that I put it through is overall return profile. So what is the average yield or the expected yield or cap rate of this type of asset? The next one is vacancy risk and industry risk. This is really, really important because the biggest risk in commercial property or any type of investing is complete vacancy. The second biggest risk is single tenancy risk. So the way that I look at this is the demand stable for this type of asset or is it shrinking? Is the sector or asset type structurally sound or is it under pressure from future technologies and the changing of human behavior? The next lens that I put it through is investor demand and deal flow. Is there tons of capital pouring into this asset or are people trying to get rid of these assets and sell them off? And further to that, are the yields expanding or are they contracting? And then the last part of this lens is how easy is it to get a deal? What's the deal flow like? It's very, very important to have good deal flow in the asset type or a reasonable deal flow in the asset type that you're going for, because it's great to have a whole investment thesis, but if you can't get a deal, there's no point in being in that opportunity because you won't be able to make any money anyway. So there has to be a reasonable amount of deal flow or ways that you can increase your deal flow so you can take down and invest in that asset. The next one for me is a big one, the value add opportunities. So can you force value onto this asset? Can you increase the income? Can you reposition it to make it much more better, profitable business and overall investment asset? Or are you speculating? Are you purely waiting for the market to make you? Can you guarantee the increase in value or is it something that you can't guarantee? That's really the question. And the last part to my 5-part framework is operational complexity. Do you need staff to run this asset? Do you need specific industry skills or systems or technology to run the asset? Or is it much more of a passive play once you sell the property? These are the things that can really make or break an investment depending on the time you have to put into your investing and your portfolio. So the first one on my list is an asset type that I actually do like. I see myself in future potentially investing in this and turning these around. But the problem with this asset is it has huge operational drag. So you need staff, you need a cleaning crew, you need to be able to have, really good maintenance on the property as well. It's all about presentation. And this type of asset is motels. So in 2026, if you're looking at investing in motels, you really need to understand and know what you're doing first. You can run a motel into the ground if you're not careful. So it's one of these things that it's a great opportunity, great overall returns. So you can really improve the value of a motel if you are buying the right asset in the right location that has been underperforming. Maybe the owner has had it for a very long time and they haven't been running it very, very well. And if you know what you're doing, you can turn that asset around and make a lot of money improving the business. But the key factor here is that you need to know what you're doing. You can't just wing this. It's something where you need to get the location right, and you need to also get the supply and demand right in that location for the motel. But in terms of motels, they can be very, very good assets, but the return profile is very, very good. The vacancy, need to know very market specific, need to understand what you're doing. The investor demand, there are a lot of people that invest in motels. It's not as big as obviously standard commercial property or other commercial assets, but there is a fair bit of demand, but there's so much deal flow. This is one of the good things about motels, is that you could easily find a great deal if you know what you're looking for, because there's so much deal flow. And so value add opportunities, they are huge in motels. You can really create huge amounts of equity and huge amounts of value and force that equity if you know what you're doing. But operational complexities are through the roof. It is an operating business and you need to be fully aware of that. So that's why motels come in at number 7 on my list of worst assets to invest in 2026. All right, the next one on the list is bulky goods retail. And I know that might surprise a lot of people, because bulky goods retail has been coveted as a very, very good asset class in the past. But if you run it through my framework, then you'll be able to understand exactly where I'm coming from. So overall return is reasonably low for bulky goods. If you're buying a good bulky goods retail shop, you're most likely going to be paying a very, very sharp cap rate for that. If you think of like your Fantastic Furnitures or your IKEAs or things like that, where you are buying a very large building, and the reason you're buying that is because of the tenant. So like companies like Fantastic Furniture and the like, they have very, very big fit outs, and they're very, very committed to those locations. So they have very long leases. So that means that it's going to be a stronger lease and a stronger investment opportunity, which means that more people are interested in it and more people are going to pay a sharper cap rate for that. So for something like a bulky goods retail, depending on the location, you're most likely going to need to be paying about a 5 or 5.5 cap for a really, really good quality one, and it could even be much lower than that in you know, your major cities like Sydney and Melbourne. So for that reason, for the overall investment return, it's reasonably low. So the vacancy risk is pretty low because you're buying into a very strong lease. So some bulky goods retailers will have a 5, even 10-year lease on it with options to renew. So a very, very common way of doing that is a 5-year lease with options to renew for another 5 years. So that could definitely be what you're looking for or what you're looking at. So they get a big tick for vacancy risk because it's very low, because the whole reason why people like them is because it usually has low vacancy. But one of the problems I see with bulky goods retail is that they are a lot harder to lease up if they ever do go vacant, because it is such a large space. So you need to be careful if you are buying a bulky goods retail shop that you're going to have a strong tenant. They've been trading there for a long time. They're very profitable, because when they go vacant, it can be a good 6 months plus, depending on the location, depending on the market, or everything like that. But it can be a good long period before you could find another business to replace them. Investor demand is absolutely huge for this type of asset. A lot of people use bulky goods retail as a store of wealth rather than a wealth creating opportunity, where they're parking capital in a hard asset and instead of keeping it in cash, and they know that because it's a hard asset, it'll go up over time, and it's more of a growth type of play than it is a cash flow return play from the get-go. From a risk standpoint, one of the big things that I don't like about bulky goods retail is that you're putting a lot of capital into one particular location and you only have one tenant. This is one of the main problems for me, is that if that tenant does leave, then you have a very, very big problem on your hands. So, and usually, to buy a decent sized bulky goods retail with a really good tenant, you're looking at, 2 mil plus. So it's a lot of money to have all tied up in all your eggs in one basket in one tenant. So this is one of the things why I personally don't like bulky goods retail, because it's not multi-tenanted. It's only single tenancies. So it's a lot easier to have a complete vacancy when you've only got one tenant. Value add opportunities. Bulky goods retail don't tend to have a significant amount of value add opportunities because it's an established tenant that's already there. You can't usually split up these sections of the property unless you find a property that is vacant and you're buying it with the intention of splitting it up into, say, smaller bulky goods retailers. That can work. Or you're buying a complex of bulky goods, say like you're buying a neighborhood center and a lot of the retailers are bulky goods. That's a little bit different. That's not what I'm talking about. I'm talking about one particular bulky goods retailer that you're buying. So the value add opportunities are pretty low for that type of tenancy and that type of property. And operational complexity, it's extremely low. It's a very passive investment because you're literally just leasing them a space and it's pretty hands off. You have a property manager taking care of any issues they have, but most likely you're never going to hear for them unless they stop paying the rent. And that's why bulky goods retail has come in at number 6 on my list of assets to avoid in 2026. Next one on the list, stand-alone retail shops. Now, this is an interesting one and it really comes down to the market. So once again, overall return is decent. Maybe like if you're looking at a good retail shop, you're probably looking at around a 6 cap to 6.5% return on a good standalone retail shop. The risk is that it's one tenant. So one tenant, again, we don't like that. The biggest risk in commercial property is vacancy. The second biggest risk is a single tenancy risk. So to avoid that, it's always better to buy multi-tenanted property. Retail is a very, very difficult asset. If you get it wrong, it's not forgiving. If you get it wrong and you have no foot traffic, it's in a bad location, chances are in 10 years time, it's still going to be undesirable for a tenant because there's no foot traffic. Retail is very, very dependent on the foot traffic that it provides and the location that it is. So thinking about this from a practical point of view, if you're buying one single retail shop in a complex of say 20 and you're at the back of the complex, then that property is most likely going to be very difficult to re-tenant when you have a vacancy. But if you have the highest foot traffic in the property and you are at the front of the complex, then that property or that location might demand the highest rent and it might also be the easiest to re-tenant when you have to re-tenant it. Value add opportunities in this one, it really depends on the property. If it's a larger retail shop and you can split it up and it has multiple doors, multiple entryways, that can be a really good value add. Or I've also seen retail shops where you have a retail at the bottom and then you have residential on top, and some retail shops you can only access from the front of the retail shop, but if you can create a stairwell or a different access point for the tenant upstairs, then you can potentially subdivide those and create 2 different lots, and that can be a really, really good value add for retail. I know a lot of people who have done that in the past when retail was the best asset out there. But in terms of operational complexity, once again, this is a passive investment, and that's why the overall return is quite low. So you're just handing this off to a property manager and they're taking care of it for you. Hopefully you have a good tenant, but the industry the tenant's in is really going to be very important here. So if you have an industry that's dying because of the internet, or how things are getting sold online, or it's going to be going away in the near future because of AI, then that might be a retail shop that you want to avoid. So that's why a single retail shop comes in at number 5 on the list of the real estate assets to avoid in 2026. All right, next asset on the list of assets to avoid in 2026, coming in at number 4 is service stations. So it's no surprise to people that electronic vehicles are taking over the market, but I still see service stations as being quite a resilient asset class. They perform pretty well over the last few years, but the future is definitely uncertain to whether or not they'll be around, come 5, 10, 15 years in the future. Now, one good thing about service stations is that they are now not just about petrol. There's fast food, there's supermarkets that are attached. It can become a lot more of an interesting asset class because of the extra stuff that you can add into it, how you can add value to it. So the reason that they've come in at number 4 on the list is that the overall return is pretty good, depending whether or not you're running the business or not. So some service stations are owned by the landlord, obviously, and then they're rented out to the person who's going to operate the business. Other ones, they are actually owned and run by the landlord. So it depends how you're running it. Obviously, if you're running the business, you're going to have a much higher return because you're getting the business return on the asset. It's a little bit lower if you're just renting it out like a standard to a standard tenant to a standard lease. So the next one is vacancy risk and industry risk. One thing I don't like about it is the future is uncertain whether or not petrol stations, as in selling petrol operated cars, will be around in future. So with petrol stations, there is a huge industry risk here because the future is uncertain. So who knows whether or not in 10, 15, 20 years that they actually will sell petrol and will still be operating petrol cars. I'm pretty sure that they're going to be it's going to be very difficult to get rid of all petrol consuming cars. EVs seem to be taking over, but who knows? So that's why for industry risk, the industry risk for service stations or buying service stations is huge because you just don't know if the demand will be there. The saving grace is that they can also have fast food on the land. They can also have a supermarket element, car wash element. There's a lot of other ways where you can create a good, diverse asset, and also multi-tenanted. That's important as well. In terms of the investor demand, there are quite a few investors that only buy service stations. Unfortunately, they do seem to sell service stations at a very, very sharp cap rate, especially ones that are big chain service stations. But there are quite a few investors that only invest in service stations, and the deal flow is reasonably good too. So most likely right now, if you searched to buy a service station, you would find a couple out there and you could have a good look at those and assess them and see if it was a good deal for you. So the deal flow is reasonably good for service stations. Value add opportunities are huge for service stations because you're usually buying a reasonably large piece of land, and you can make it multi-tenancy, you can add in other things. The value add opportunities are huge. So if you say buying a service station that has an extra piece of land to it, you could always put in a food truck, you could put in a hand car wash, you could develop another building to be able to put in a fast food restaurant, things like that. It's a dime a dozen. There's a Hungry Jack's, KFC, sometimes even McDonald's on these service stations. So there is really good opportunity to add value to service stations. Operational complexity really depends whether or not you're the actual person operating the business or not. If you're a landlord and you've just leased it out, nice and easy and passive because you're just collecting rent. The difficulty really is in operating the business. So it just depends how you're actually operating it. And for those reasons, that's why service stations are number 4 on my list of worst assets to buy in 2026. Next one on the list, coming in at number 3, is none other than office buildings. So buying an office building, and I'm talking about the whole entire building, where you own every single office suite, and it's all on one title. I'm sure everyone is aware that the office sector was decimated in COVID, And it's coming back sort of now, where a lot of businesses are demanding or requesting their workers to come back and be in the office, at least for, 3-4 days a week. They might have 1 day of working from home, but all in all, CBD office towers have been absolutely decimated. You do not need to invest in these. If you're looking, you have big capital, do not touch these. There are so much better assets out there that have a much lower risk profile, better overall returns, lower vacancy, better ways you can add value, and also are easier to operate. So office buildings by far are one of the worst assets you could buy. And if there is a serious property crash in our near future, it will be because of banks holding too many office assets and they've been revalued at a lower rate and they're underwater. So that being said, office buildings come in at number 3 on the list of worst assets to invest in, the ones that you need to avoid in 2026. Next one on the list, number 2, along the similar lines as the last one, but much worse. So the next asset type or real estate type that you definitely need to avoid buying in 2026 is a single office suite. So the only thing worse than buying the whole office building is buying a single office suite, especially if that office suite is in the CBD somewhere. It's just a terrible investment right now. You're just basically burning your money, and there are a lot better asset classes that you could be investing in and making a lot more sense and a lot more money and actually having your money returned to you. So office suites, the return is actually reasonably high as a term of a cap rate. Because there's so much vacancy, people are selling these at a discount to get rid of them. So in terms of overall return, it's actually not too bad. And the vacancy risk is absolutely huge. There are just so many office suites around Australia that are vacant, particularly in CBDs. No one wants to go into the CBD anymore. No one wants to battle the traffic for an hour to go and work in an office tower. We just don't want that anymore. Some office properties, neighborhood office, can do okay, but it's very market specific and you need to do your research. In terms of value add opportunities, there are a couple of ways that you can create value in office properties, particularly if you're taking a larger office suite and splitting it up and turning it into 2 offices, or creating a cage in the bottom in the car park, putting in some extra space, so you like extra net little area that you can charge for. But it's very risky because you might be doing all this work, splitting it up, and then you might not be able to get a tenant anyway. So very easy to avoid these assets. Don't even look at them. I wouldn't touch it with a 20-foot pole. All right, we're getting close to the very worst asset that you could be investing in 2026. But if you want to listen to the 17 worst to best assets, I have just released an episode on my podcast, the Commercial Property Show Australia, where I list the very worst asset, which is the next asset coming up to the best asset. And there are 17 that are ranked in order, and why they are where they are and everything like that. So if you want to jump on to check out that podcast, the podcast is called Commercial Property Show. It's by me, Andrew Bean, and you can listen to 17 worst to best assets. All right, but getting to the main event, the worst asset type that you can possibly invest in 2026 may upset people, and I don't really care. So the worst asset is by far a residential apartment. So in Australia, just to be clear for all of the American listeners or all the American viewers, in Australia, people invest and buy a single residential apartment. In America, they actually buy the complete residential apartment building, which is very different. That could be a great asset to invest in. So what I'm talking about is a single apartment in a unit block, and you're buying that. Now, the reason that these don't perform very well is because there's no scarcity or no lack of supply for airspace. So developers can just keep on developing more and more and more of these apartments because there's just lots of space in the sky. There is, however, and I do believe that there will be a larger demand for residential apartments going forward, purely because of the affordability factor that people can't afford to buy a house these days. And over time, the Australian dream or the American dream of owning your own home will most likely turn into the Australian or American dream of owning your own apartment, which is pretty sad. But it is a fact of life that things are getting more expensive, so demand will be higher. I can admit that that's going to be happening, or I can agree with that's going to be happening. But in terms of the supply, which is one of the main pieces of why things go up in value, is that there's no lack of supply. There's just absolutely no chance that we're going to have a finite amount of these, because if there was, apartments would go up significantly. You know, there's a reason why apartments haven't performed as well as actual residential houses, single family houses, over the last 10, 20, 30, 40 years. They just don't have the same capital growth. They do have some capital growth, but it's nowhere near the same amount as if you had to just put your money into a residential house. The only exception to this is if you're buying an apartment in a highly desirable beach location like the northern beaches in Sydney. So if you're buying an apartment that has water, oceanfront views and it can't be built out, they actually can do reasonably well. But what I'm talking about is more buying a residential apartment in your western suburbs where there's just no lack of airspace, there's no lack of land to be able to stop these from going up and having a shortened supply. These are the types of assets that will wreck you. They're not even a cash flow play. They have very, very bad returns, usually negatively geared. The vacancy risk isn't too bad because we are in a rental shortage. So most likely there are people that are going to be renting these in future because of the affordability of renting a family home as well. Investor demand isn't too bad. So unfortunately, people who are uneducated in real estate assets, they seem to think that buying a residential apartment because they can afford it is the right thing to do, that parking your money there is going to have huge capital growth in future. And unfortunately, a lot of people now that invested 10 years ago, they're selling the apartments if they're trying to sell them for the same exact price that they purchased it. So you have no capital growth, or very, very limited chances of capital growth. You have no cash flow as well. It's just a terrible asset to go into. There's much better things that you can be investing in that give you great cash flow, and also you can force huge value to and have great capital growth as well. Value add opportunities are usually very minimal. You know, maybe you might be able to take a old 70s brick construction, you might be able to renovate the kitchen, renovate the bathroom, things like that, and to get a little bit higher rent out of it. But ultimately, that's not always what changes the value of the property. You could have the nicest property inside, but the comparable sales around the property of the shitty apartments around are what is determining the value of that asset. So value add opportunities are very, very low for this type of real estate. Operational complexity, it's not a difficult asset to run. You're going to be handing this off to a property manager and they're going to be taking care of it for you. Unfortunately, residential tenants do break things. They don't treat you properly nicely, and you're going to have to keep on pouring money into that asset, fixing things. You know, every single thing that breaks on the asset is your fault, not the tenant's fault, even though they broke it. So unfortunately, you're going to be footing the bill for every single expense, repair and maintenance on the property. All right, that has been the 7 worst real estate assets to invest in 2026, the ones that you must avoid. And if you want to find out the assets that you should be buying, the ones at the top of the list, the ones that have great returns, great capital growth, and ways you can add significant value to these assets, check out the video just up here to see the types of assets that I'll be buying in 2026. That's the video. I'll see you on the next one. Bye.